Hello again, everyone, and Happy New Year. It is Wednesday, January the 5th, 2022. I'm John Kosar of Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most important charts and data series that I believe are going to be the most influential through the end of January and potentially much deeper into the first quarter of the new year. Our first one is market internals. The Asbury 6 is positive. Those who are Asbury Research subscribers or may be familiar with me through various podcasts or other places around the internet that I can be seen, the Asbury 6 is our own quantitative metric that we put together in order to get a true under the hood reading of what the health of the market is day to day. The reason we did that is because algorithmic trading, computers trading with each other, really comprise most of the volume day to day that you see in the market. And as a result, we get a lot of crazy swings day to day where you get up in the morning, the market's up 50, closes down 30, and the next day it's up 40 again. Very, very difficult to try to gauge on a day-to-day basis what's going on in the market by just trying to follow the crazy gyrations of the S&P 500 or any of the other major indexes for that matter. So we look under the hood. The Asbury 6, the only one constituent of the Asbury 6 that looks at price action is the rate of change in the S&P 500. All these other 5 are what I would call secondary indicators. The relative performance between stocks and bonds, investor asset flows going into the SPDR, which is the ETF that tracks the S&P 500, of course, corporate bond spreads, trading volume, and market breadth. So we look at all of these through a 21-day lens, which is our tactical time period, and we get a much better and more consistent reading of what's really going on in the market, not just if the S&P is up 50 or down 50 tomorrow. All of these numbers inside the cells, those are the dates that that particular constituent either turned positive here or negative here. 5 of 6 are positive. And in my view, the only reason that 6 are not positive right now, and the 6th one is trading volume, is because of the typically low volume period that starts really after Thanksgiving and extends through the end of the year. Sometimes that will play some tricks on balance volume and other metrics that will measure volume. But the story here is the Asbury 6 turned positive on December the 22nd. And as long as it remains positive, that is 4 or more of these constituents stay green, it will continue to be positive, and it will suggest to us that conditions are good for the stock market to continue moving higher on a tactical basis. Number 2, chart patterns. S&P 500 targets 4950. Here's the S&P going back to August daily, and what we see here is we peaked in September 2nd. We had that little correction that never really went anywhere, and then we made new highs, and then after peaking on November the 22nd, we came down and held that support from September 2nd on December 3rd. Then we held it again on December 20th. This is December 20th right here, and we broke out of this sideways coil. This was very violent if you were trading it. We broke out of there on December 27th, which, because of the Christmas holiday, was only 2 days after the Asbury 6 or the A6 went back to positive, which was right here on the 22nd. So 2 trading days later on the 27th, we broke out of that pattern, which allows us to make a measured objective of 4950. As long as we stay loosely above the upper boundary of the investor indecision area at 4724. So you can see your underlying support levels there pretty plainly. Above 4724, this pattern and breakout points to 49.50. We still have 45.46 support off of the September 2nd high. And of course, the 200-day moving average, which many people view as being major support, down at 43.31. Number 3, benign volatility should facilitate more market strength. One of the ways to measure that is to look at the VIX, the CBOE Volatility Index, more commonly known as the VIX. 2 important takeaways on this chart. For about the past year and maybe a little bit longer, we've been looking at 24 in the VIX as a line of demarcation between whether we're having a pullback in the market, which we just had a bunch of pullbacks in 2021, and really never a correction of any consequence, certainly. And that's 24. If we get up to 24, stall there, and move back down in the VIX, that's typically a bottom in the S&P 500. You can see all of these bottoms here just by looking up and down on the chart. The only period that we stayed up above 24 was November 26th to December 6th, and that gave us this, but it really didn't go anywhere. We just couldn't seem to get any legs here. It came into that support that we talked about from early September and held. So the most recent one of these was these 20, and that was that was actually the 4th point of the triangle right here, that triangle pattern that we looked at in the prior slide. You can see it got up there for one day, stopped, and it came back down. We also look at the 21-day moving average in the VIX. If we get above the 21-day moving average in the VIX, that's going to tell me that we might be getting into some kind of a near-term top here, like we've seen in other aspects of this chart. If we get up above 24, I'm watching that really closely to see if that's just going to be another bottom like we had on these 20, a scary bottom, but a bottom nevertheless, or if there's enough fear in the marketplace to give us a bigger move down, an actual correction, which we're overdue for. So down below 1969 in the VIX, all systems are go. Above 24 on a steady basis in the VIX is indicating to us that conditions are good to have a long overdue correction. Number 4, lack of leadership is still a problem. Watch the semis. This has been 2021 has been a very odd year in that you didn't really have any consistent leadership from any of the normal indexes that will give you leadership, like small cap or semiconductors or tech. They all kind of were passing leadership around like a hot potato. What dragged the market up last year was really a handful of stocks, your Apples, your Microsofts, your Nvidias, that because of their huge market cap, they were just kind of single-handedly able to drive the market higher, even though your market breadth was terrible for most of the year. So this is what we're looking at here. The most consistent leader, and the leader right now, or at least recently, has been the semiconductors. Here's the relative performance down here in the lower panel of XSD, which is the spider version of the ETF that tracks the semiconductors, XSD. And you can see that it's been the relative performance line between XSD and SPY has been above its 63-day or quarterly moving average since August. It's tested it a few times since then, and it's held it. 63 days is our strategic time period. But now once we got into November, you can see it really had a tough time getting up above its February 16th relative performance high. It's still struggling to hold that. It's kind of bouncing off the, this extreme on the upper level, and down at the bottom it came down, and again, it tested and held a 63-day moving average underneath, and now we're sitting right on that line. Also, something else to watch is the 50-day moving average in XSD. It was tested on the 20th, which was our bottom in the S&P, in early October and in mid-July. So this is a tactical inflection point for semis. Semis must continue to outperform and must get back above this February 16th extreme and relative outperformance while holding 236.90 outright in the 50-day moving average. If it does not, if we break both of these trends, both outright and relative, unless something else comes to the rescue, like small cap or technology or something else, and grabs the market by the horns and drags it higher, this could be an early indication that we're going into a correction. So this is one of the most important charts for us, certainly over the next couple of weeks or so. Finally, seasonality. Seasonality, to me, doesn't mean a lot unless you've got the backdrop for something to happen that would coincide with what you see in seasonality. And this is a seasonality chart for the first quarter. These 13 bars here represent the 13 weeks of the first quarter. And you could see that the first week of January, which is this week, is by far the strongest. And then seasonality slowly kind of rolls over. February on an annual basis is the second weakest month of the year in the S&P 500 based, again, on data since 1957, second only to September. So seasonality is a factor here. So again, watching the VIX, we're watching relative performance of semis, we're watching that support level in the S&P 500. As long as all these things stay intact, we're staying bullish and looking for that 4950 to 5,000 area in the S&P. If these critical areas start to lose their mojo, they start to lose their strength, it's going to give us a little heads up that we may be looking at another February period that could be something like the one we had in 2020 because the market is so historically overextended. So there's your daily 5 for today. Thanks for watching. If you like our approach, feel free to visit us at www.asburyresearch.com and sign up for our free bi-weekly market report. Have a great new year, all, and we'll see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.